This is the Value Investor Podcast with Tracey All things value, all the time.
Welcome back, value investors. So with the big growth names hitting new all-time highs yet again, and many of them trading over $100 a share now, I thought it'd be fun to look at some stocks that are trading under $10 because, let's be frank, we all love stocks under 10. It's a weird psychological thing, but there's just something about buying, 25 shares of a $4 stock for my $100 instead of just getting one share for my $100. It doesn't really make any sense, but it's more fun to do the first example than the second one. So I know you all like to look at stocks under $10 because, quote unquote, they're cheap. But I thought I would screen for that and throw in some value fundamentals to get real cheapness. So cheap fundamentals plus under 10. Those are fun. So I had no idea what I'd find when I combined some of these things. I didn't even know if there were many of these out there. But what I used to screen was obviously stocks under $10. And then I used the price to sales ratio for my value fundamental this time. And remember, the price to sales indicates that we're getting sales at the discount. So you look for price to sales ratios under 1. So for example, a price to sales ratio of 0.3 means we're paying just 30 cents for every dollar of the sales. So basically it's on sale. And that's what we want to get. That's where the value component comes in. I didn't use PE for the screen. I still kind of looked for the low PEs when I was looking, but I thought it'd be too narrow if I also included the PE or if I just went completely with PEs, and I thought I'd just use price to sales instead. I did add a Zacks rank. I used 1, 2s, or 3s this time because I wanted to keep my options open. And again, I didn't want it too narrow because I was scared I wasn't going to get many things if I kept it just a rank of 1 or 2. And we're also in earnings season right now. The rank is very volatile during earnings season. And if companies haven't reported yet, they're most likely to be a 3 or even a 4. As some of the estimates are dropping off, they'll turn to a 4, which is a sell right before they report earnings, like literally the week or two before. So I didn't screen for the 4s, but I did keep the 3s in there to keep companies that maybe haven't reported yet. And when I ran this, I got 237 results. So, I was surprised. I went, wow, when I ran the screen. And that's because the price to sales ratio will find a little bit different value than the PE. Now, remember, to get the PE, you have to have actual earnings. You can't, be losing money this year or, you have to have the E part. So that's also what allowed us to get 237. If we did the PE, it would be much lower. Now, some of these stocks, because I just did $10 and under, they were under $1, basically penny stocks. And I know some of you love those, but I just can't go there. So I immediately discarded all of those. And that got rid of quite a few as well. So what was in here? It was some interesting names. There were energy companies, especially the drilling service companies. So I don't know what's going on there. Some of them haven't reported yet. I was going to investigate that further because I was surprised at, how low some of those were trading. So something's going on. And then, of course, the retailers. Yes, a lot of the smaller mall-based retailers or just small cap retailers in general were in this screen. In fact, probably all the ones you know and love or know and hate as the market, dictates. So some of them are going to be in these 5 stocks I give you, but there were way more than that. I could do just a whole episode again, which I know I've just done on the retail stocks. A lot of them haven't reported yet though, so we're waiting to get some of those in before I address that sector again as a whole. But let's jump right into the 5 I did find because there are some interesting names in here. And I really tell everyone to weigh the risks with stocks under $10. These are value stocks, so obviously they're also out of favor, some more than others. Some are basically, I'll just be frank, totally hated. It doesn't get any worse. You have to have some real guts to get into some of these, and you'll know the ones when I'm talking about them. So let's jump right in. The first stock is the Container Store. TCS is the ticker. I've said for years this company should never have gone public. They just, most of their quarters, it's been a disaster. Let's just call it that. It's like they've never met expectations. Same-store sales have been awful. They're reporting again November 7th, so they haven't reported yet. They have kind of begun to turn it around, it looks like. They have expected to make 31 cents this year, 2017, and 39 cents next year. So they do have a PE. It's 11.8, so that's pretty cheap. And their price to sales ratio is just 0.2. Basically, this is one of the ones, everyone hates it. It's near new lows. It's down 91% from its 2014 IPO. Everybody's just said, writing it off. It's just $3.60 now. This is ahead of the earnings report if you're listening to this. It's one to tune in on, but like I said, everybody hates it, but they actually do have earnings and it's supposed to grow for next year so far, supposedly. So we'll see. So that's one to keep on the list. Second one, Noodles & Company. This was also a 2014 IPO. This is the restaurant chain. 2014 was the big year for restaurant IPOs. Everybody was launching, but maybe everyone shouldn't have been. And this might be one too that maybe should not have gone public. This stock is also near all-time lows. It's down 88%. It's basically been abandoned by the market. This is a typical value stock. They are expected to see a loss this year. We only have 1 cent right now. Supposed to rebound to 6 cents next year. They lost 17 cents in 2016. Just has not been a good story even from the IPO. Restaurants, very competitive, as I've discussed in the past, but they have a price to sales ratio of just 0.3 and they're $4.35 or so right now. So under $5. Noodles & Company is that one, NDLS. The third one is in a completely different area, and these guys have been around since 1925. The Manitowoc Company, ticker MTW. Anyone in Wisconsin knows them and knows their name. There's a town named that as well. They are one of the largest crane manufacturers, and they do a lot of lifting solutions also. So this is on the industrial side. But when China slowed down and just the global economy did, but especially China the last couple of years, they were really hit. So these shares are way down. They are just under $10, around $9 or so. They're expected to lose 15 cents this year, but the analysts do see a rebound in 2018, making 7 cents. So that's always positive. They do have 1.5 billion in sales in 2017. So that kind of gives you the size of what it is they do. They haven't reported yet either. Supposed to report on November 6th. So that's coming up quickly. This is one to watch. No PE because they have that loss this year. And the price to sales is 0.9. So an interesting industrial to keep on your list. And then our fourth stock is a refiner, Calumet Specialty Products. CLMT is the ticker. They haven't reported yet either. They're reporting on November 10th, so we're going to wait for that. But they're also pretty large. They have $3.8 billion in sales in 2017. That's what's expected. But they lost because of problems in the energy group and in chemicals, $3.27 last year, $3.27. But they have improved in 2017. They're expected to see a loss of just 25 cents. But 2018 for right now doesn't look that great. The loss widens in 2018 to 95 cents, but really cheap, price to sales of just 0.1. They traded under $4 earlier this year, and the stock has doubled. So they are a lot higher now, but still under $10, but still down 85% in the last 2 years, even with that doubling. And that doubling is probably due to the fact that the refiners as a group are pretty hot in the last couple months and have seen a big rally. So they've kind of gotten picked up in that is what I'm assuming. But you might want to listen in on that earnings report too to kind of see what's going on in the refining sector. So CLMT is that ticker. And then we do have another retailer. This is an interesting one because they do have some retail stores and then they sell in like the department stores and all of that. Fossil, FOSL. Yes, they're the watch guys. One of the biggest watch manufacturers, but they do department store watch sales and also a little bit nicer, like the higher end. They also help manufacture for some of those companies. And they also do apparel, a little bit of apparel, I guess, and accessories like handbags, wallets, things like that, if you ever go into one of their stores. But this was a $125 stock and in 2013, and now it's at $7.88. So the stealing of the wealth there is pretty massive. Even year to date, this year alone, it's down 57%. So still, everyone's abandoning this one. They believe no one will ever wear a watch again, apparently. And this is also mixed up with the department store story because as everyone's thinking they're doomed, Fossil sells a lot of watches, through the department stores. But this one is profitable and they are expected to make 68 cents this year. That is down dramatically from 2016 when they made $2.44. So I'm not trying to paint a super good picture of what's going on, but they are expected to make 68. And then 2018 expected to make 75 cents. So you have to wonder if maybe the worst is over here. I don't know. We won't know. They haven't reported yet. It might be any day now. I couldn't totally tell when their report date is, but it's coming up soon in early November here. They have a PE of 12.4, so cheap, but not as cheap as you might think because those estimates are way down. But the price of sales is just 0.1. So it's an interesting story. And, I asked around a couple watch guys here in Chicago. This is just anecdotal. It's just one watch maker, but he was telling me that the mid-range watch is still selling quite well, and to both men and women, variety of age groups, and even to millennials, that's the watch that's like $100 to $250, and they see it as kind of a fashion accessory. So it's not too pricey, and you're not making a big investment in it, and you're getting something new to wear. So take it for what it's worth. We won't know until Fossil reports. But they're also expanded a lot into the wearables. And strangely enough, their main competitor that everyone was worried about in the wearables, other than Apple, was Fitbit. And they are also on my list. So I'm just going to mention them quickly. They're also under $10. They're trading around $6, I think, now. Those shares are down 84% since their 2015 IPO. They have a price to sales now of just 0.6. So it's kind of ironic. Fitbit is also on this list and also basically been abandoned by the market. So both Fossil and Fitbit, nobody's buying either the wearables or the regular watches, apparently. They think they're both in trouble. So yeah, keep an eye on that area because I'm going to. I find it interesting. And remember, I'm listing out all these companies, but the question I always get is, could they go bankrupt? What happens to me? If the company goes bankrupt, you lose everything. Trust it. For me, this has happened to me in the past. Bought a stock under 10, they went BK, all shareholders get wiped out. You're like way down the list to get any money. No, you're not going to get anything. So this is something to keep in mind. We saw this in 2008, 2009, that anyone could go bankrupt. It doesn't matter what size the company is, the pedigree, that it's been around 100 years, because I guarantee you no one believed Bear Stearns could go under, or, most of those big banks that have been around forever, no one believed any of them were going under either, or even the automakers, all of this. So you can't ever say never about any company. So my advice always is to be, check the balance sheet, buy companies that are making money or that have a plan to make money. That's the whole point, right? You want to own companies that are doing something good. And another kind of key is to look and see if the insiders are buying. And if they're not, you have to ask yourself, why not? Because some of these stocks that I just mentioned are dirt cheap. And if you worked for them, wouldn't you want to get it dirt cheap too? If the stock's trading at $3 and you know something good is happening at your company and that better days are coming, wouldn't you be jumping in to buy it at the $3? I would, because that's why we're all looking at them, right? So it's a little bit of a red flag if they're not buying. If it's at new multi-year or all-time lows and nobody's buying who works there, then that means even they don't believe, the insiders don't believe. So keep an eye on the insider buys. It's not 100% guarantee, but if a company's going under all the way, I guarantee you the insiders are not going to be buying. Why would they throw their money down the drain? They're not gonna. So it's something to keep in mind as a little clue for the ones where they are buying. If they start buying some of these beaten down retailers, some insiders have been. I've covered those, but I will again after this earnings season and see who's diving in for more. We know that some insiders bought Macy's after last earnings quarter. When that stock plunged, it's down even lower now. Will they buy again? We don't know. But these are signs. So be sure to keep an eye on that. And also, as I always say, listen in on the conference calls. A lot of these haven't reported yet. Listen in. Don't just review the transcripts, because you can tell a lot by the tone of the voice. Do they sound excited about anything? Or are they defeated? You can always tell when management is defeated on the call by their tone and just kind of how they go about answering the questions. Do they snap at the analysts? Like, yes, that does happen. They get annoyed at the analysts. Sometimes listen in. You don't have to listen to live. You can listen in on it later. All these companies will put it on their website, and you can always, just listen on your phone or driving in your car. So that's a good thing to keep in mind. And one other thing about stocks under 10 in general, I always get asked this too, how low can it go, Tracey? Well, it could go to zero, as I've been mentioning. So never say never. Just because it's at those multi-year lows doesn't mean it can't go lower if things are still not going well in the business. So all stocks under 10, you're taking a chance. That's why you got to look at those fundamentals. Keep looking at the Zacks rank. Try to find some of these cheaper stocks where the earnings estimates are rising. Look for companies that actually have earnings. Some of these don't, but are expected to. So keep that in mind. So let's list the tickers here. We had the Container Store, which was TCS, Noodles and Company, NDLS, the Manitowoc Company, MTW, Calumet Specialty Products, CLMT, Fossil, FOSL, and if you're interested in its competitor, we had Fitbit, FIT. So I gave you an extra one there, so we really have 6 today, but 5 are the key ones. So remember to subscribe if you want to get all of our shows here on the Value Investor Podcast. We now have a standalone show on iTunes, so you can get us on iTunes or SoundCloud. But if you want both the Value Investor and the Zacks Market Edge, where we cover just kind of broader market questions and concepts, you can also get both of those under the Zacks Market Edge on iTunes or SoundCloud. So both are available on each platform, and be sure to subscribe so you don't miss a show. I'll see you again next week with some more value stocks.